Up next, we have Laramide Resources. Marc Henderson, President and CEO, will be joining us. And uranium miner or uranium exploration and development company looking at ISR projects in the US and in Australia. So taking it a bit of a different approach now to the Green Energy Initiative. And Marc, I really appreciate you joining us this morning. Thanks for coming on.
Okay, I think, can everybody see that?
Yeah, that looks good. Thanks so much.
Okay, yeah, very good. And yeah, so we're talking about energy generally today. Uranium, as everybody knows, is a pretty important part of the electricity generation in the world. It's been through a rough go for a period of time, but we're a uranium developer in what I think is going to be a new emerging bull market for uranium. And without further ado, we'll crack on and talk a little bit about that. I'm going to speak at the beginning a little bit about the macro, because the macro in uranium is probably more important to this sector than I think any of the other commodity sectors. And there's an incredibly high correlation amongst the names in the group, which you possibly don't see in other commodities, particularly not in the development universe. So that's sort of an interesting takeaway right from the outset. We have our normal. I'm trying to get the disclaimer. I skipped through that really quickly. So we have a development company that's got a couple of big, very interesting world-class type assets, chunky assets in 2 different jurisdictions. We're a diversified player, and we're set up basically to be a supplier of choice to the utilities of the world and the nuclear power industry in general. Nuclear power has a positive outlook. It's had historically got up to as high as about 20% share of electricity generation. It went through a little bit of a wobble, as everybody knows, post Fukushima. I think we're on a pretty big comeback in that business now, as you start to see other nation states sort of look at nuclear and look at all the various alternatives as we try and address zero emissions and that sort of thing in the world. Sort of a little history of where we've been in nuclear. The cycles in nuclear, the important thing to remember, because it's the sort of longest lead time that there is in the business world, the stocks and the commodity price and what have you are very tied to a very long lead development cycle, which is really related to building nuclear power plants. I mean, it goes through waves of development, as you saw in the 70s with the American build out. You can see in the screen here, we go from the period from 2005 all the way up to the present. The big, huge boom we had in the period of time from sort of 2003 to 2008 was related to the Chinese build out. When they went from essentially no nuclear power to 60 gig of nuclear power, they sort of adopted a nation state plan to address electricity production. And obviously, economic growth is all tied to energy production and electricity generation. And they basically stuck to their plan, and they will come very close to hitting their 60 gig target in 2020. And now they're into a next phase of development, which basically means nuclear has quite a prospective growth profile, really just based on what China is doing alone. But now there's a lot of other players involved. Now, you can see we went through a long period of time with the Fukushima incident. And what that caused was everybody in the world that was in nuclear to address safety, so that I think it's probably the safest form of power generation in the world now, post all the changes that have been made. We went through the world's longest bear market. It was almost 10-year bear market. We think that's ending now. You can see we went through on the right-hand side of your screen there. We've had a number of developments in the last few years, which are sort of indicative of kind of the warm-up phase for the next bull market. And essentially what you had with that, the reason you had such a long bear market is you essentially turned off 10% of the uranium demand, the nuclear demand in the world overnight. It took a long time to fill that demand shock. It was accompanied by what I consider to be a supply shock, which is that the nation of Kazakhstan, which is now the largest. Yeah, so I was really talking about why we went through such a long period of time. It was really a demand shock because of the plant shutting down in Japan, especially, which was 10% of demand, accompanied by the fact that Kazakhstan never really dialed it back. So in the last 3 or 4 years, we've started to see the most important suppliers sort of get supply discipline. And now we're starting to see indications that the market is sort of tightening up rapidly. And you're sort of seeing the same footprints in the market, if you will, and I'll speak to that a little bit later, with some of the financial players, the Sprots of the world and what have you, basically buying physical, trying to tighten up the spot market. The spot market price, for better or worse, is really the most important indicator when you're a participant in this uranium space, be it the producers or developers like ourselves. As I said, the demand profile now, based on the organization that is the most important organization, the World Nuclear Association, they do these demand projections every couple of years. So this is from 2019, but as you can see, even the lowercase price basically has very modest compound annual growth of electricity production. The uppercase is really quite robust, and that's a market that's robust when they make those predictions out to 2030, 2035. So this is one of the few commodities that's really not GDP correlated, which is another thing that's important to remember in uranium. So all this really leads to, I think we're in the early stages of something that is a very long cycle thing to begin with. And so the fact that some of these names and stocks have moved up should not be a reason not to be a participant. In terms of where the uranium in the world comes from, this slide sort of shows you the top 5 producers in red, and then the next 5. And as you can see, it's a very highly correlated supply chain. And that obviously has ramifications for people that are participants in the market, particularly utilities and what have you, that are trying to access supply. So supply is very much, and security supply is very much a dominant issue in the uranium business. And one of the reasons we put together a profile of projects that we think are ideally situated both on the cost curve and in terms of where they are jurisdiction-wise, because the goal of a uranium development company like Laramide is basically to have a diversified portfolio of projects that can kind of be the supplier of choice to some of these nuclear utilities. In terms of where our projects are, as I mentioned at the top, we have a big development stage project called Westmoreland in Australia. We have a very exciting greenfield thing adjacent to that, which basically accompanies the entirety of the geological belt. And then we have, and that's an open pit mine in Australia, very shallow, very good recoveries, et cetera. We'll speak to the dynamics of the project here in a minute. The other one is a very different form of mining. It's in situ recovery mining, which is essentially solution mining, which is how all the production in Kazakhstan, the world's leading producer, produces uranium. And so we have what we think is one of the better American development assets in ISR. This is a photo of our Church Rock project. You can see there's a mesa off in the distance. The deposit itself sits at the base of that mesa. And essentially, when we're finished mining with our project there, the benefit of ISR is it'll look just like that, because essentially with ISR, you're doing a well field recovery, you're moving water around, you're recovering the uranium out of solution from the water and processing it, typically off-site someplace else. And then when you basically cap the wells, and the remediation is basically restoring the aquifer. So it's, in terms of political acceptance, environmental acceptance, it's probably one of your more benign forms of mining that you can find anywhere in the world. This particular project has a long history. It was originally discovered, believe it or not, by General Electric, or by a division of General Electric. Nuclear is interesting because a lot of the American projects, with some of the ones that are still around in production, offline at the moment, et cetera, were really found in that boom in the 70s. And in the 1970s, basically every oil company or energy company had a uranium division, such that by the end of the 70s, the companies like Chevron, Ohio, et cetera, were all the folks that were out exploring for uranium, because nuclear power was essentially going to be the future. So there's a little bit of rhyme going on with that, if you see what's happening now with battery metals and what have you, because a lot of those same oil companies now are sort of looking at renewables and other forms of energy. But nuclear is one of these things that's basically only gotten better in time, frankly, in terms of, other than the cost factor, when really the cost factor of building a plant, in terms of the cost of power, it's still one of your cheapest, cleanest forms of power. So we think nuclear is going to make a big comeback. In terms of where our American resource sits, you can see that we have a very substantial resource base. You see in the lower left corner there, with very good grade. But in terms of how the market's valuing it, we think the market is not giving it the value that it ultimately probably will. If you see some of the other names that are in there, you got a mixed collection of things that trade at higher valuations, including one ISR company in Australia, the new discoveries in Saskatchewan that everybody knows about, and they get a premium, obviously because of scale and perceived margin, because they're very high grade. But ISR is actually equally cost competitive with any other form of production, part of the reason that Kazakhstan is obviously the biggest supplier in the world. In terms of our Australian project, as I said, it's more of a conventional mine. It's a conventional open pit mine with a 2-to-1 strip ratio, very shallow, 60 meters depth, as deep as it goes. Very high recoveries in the 90s. We'll do a 10,000 ton a day plant there to produce about 5 million pounds a year. It stacks up very well against other development scale projects, both in terms of cost and in terms of CapEx costs. We've done a couple of advanced studies on this project. The most recent one has a capital cost just south of $300 million and an operating cost just south of $20. These type of projects, which are a little bit bigger, the ISR projects typically lend themselves to coming online at throughput rates of around £1 million a year. This one will come on at £5 million a year, which would rank it as a relatively substantial project. That gives you a sense of where it is. It's in the top end of Australia, just south of the Gulf of Carpentaria. You can see there's a dashed line on that map there. That divides the state of Queensland and the state of the Northern Territory. As you can see, we've got concessions straddling both. Westmoreland is the development stage asset in Queensland, and then we have this what we think is a very exciting greenfield project in the Northern Territory. Both of these projects, the provenance of both of these projects was Rio Tinto ultimately. And so they're very well-known, very established projects. In terms of the capital structure in our company is about 170 million shares, and there's a few more out than this slide suggests because we've had some warrants come in recently. We just had a warrant exercise that went through, and also the cash balance has bumped up as a result of that to closer to probably $4 million. We haven't done a lot of financing recently, mainly because we've got a lot of in the money warrants and options. In fact, every warrant and option in our company's in the money at the moment, and that brings in another 12 to 14 million, which we think is just sort of going to come in to the treasury as this market advances here over the next 12 to 18 months. The next substantial warrant series is in about 6 or 7 months' time. Insiders own a little over 10%. We have most of the usual suspects in the uranium space that own the name, including 2 of the 3 ETFs we think will get added to the biggest ETF, which is an ETF now that has about almost $1 billion in it. We think we're going to be teed up to be added in the next inclusion go around, which should be in about a month. In terms of where we sit, the ETFs are actually a good place to start if you want to do research in uranium. There's an ETF run by a guy named Mike Alkin, who's a very well-known guy in the space. He set up a competitor ETF to this one I just mentioned, URA, which really had more of the junior names, more of the torque to the space in it. It's basically who's who in the business. As you can see, we've got a market cap now around 100 million. We think there's a lot of room for us to move up in that peer group, mainly because we're not in the other ETF, and mainly because because of the bear market and what have you, we haven't been doing a lot of marketing. And also the space itself, we're coming off the bottom in uranium. We've had a rally in it, but we're at $32. There's nothing in the business that works, including one of Cameco's 2 biggest mines, that really works at $32. So as I said before, we're very early, we think, in the commodity recovery in this particular commodity. And so that's something to bear in mind. We think we're on the verge of, I think we're in the 2nd inning essentially of this market, maybe going into the 3rd inning. It's going to be a little bit different than the last bull market. In the last bull market, we didn't have any ETFs, and we didn't have a lot of the retail avenues, if you will, including something like this podcast here today. None of that was around before. Twitter wasn't around. We have a much more interesting market where companies can access shareholders. So we had a pretty wild bull market in the last cycle. Uranium went from $7 to $135. So far, we've gone from sort of $22 to $32. So as I said, I think it's pretty early. What else? Yeah, in terms of knowledge base, in the prior cycle, part of the reason we ended up having so many new companies, emerging companies, was the public hadn't really seen a uranium bull market in probably 15 years. And so as you can imagine, every property that had any kind of trace element of uranium in it got brought to market. We went from 10 companies in uranium in about 2002 to, I think it peaked out around 700 companies between the ASX, AIM, and the Canadian exchanges. We think it's going to be a little bit more constrained market this time around, mainly because most of the quality development projects in the world that matter are essentially in that slide I showed you in the prior slide, inside those companies that are basically inside the ETFs. That essentially is your development universe of developable uranium projects. And we frankly probably need all of them in order to satisfy the demand that's there, just to provide fuel for the approximately 500 nuclear reactors that there'll be by 2025.
Great.
So,
Mark, I do have to jump in here. Unfortunately, we are out of time. I think that was a great note to end on because we do need more uranium. There's lots happening in this space. And I really appreciate your time and presentation today.